With all this volatility, we are pleased to welcome our first alternative guest. David Rich is here. He's the founder and CIO of Amida Partners. David, thanks so much for coming in, especially on a day like this. What do you make as a hedge fund manager of this volatility? Where do you see opportunity?
Well, one thing we do know now is we know that we don't know which way the market's going on any given day. So as a relative value manager, one thing I want to try and do is find options. And we think that we can find some cheap options in the convertible space right now.
Explain a little bit what the options mean, because I know the primary sort of focus of your funds is through converts. So what does that mean in a market like today?
Well, what it means is it's always good to have volatility if at your disposal if you can get it. The question is sometimes it's very expensive. So convertibles, if you pick the right ones, can effectively give you the chance to own options in this type of environment, but more cheaply than you can otherwise get in the listed market.
So that's sort of how, in part, you're at least managing a little bit of this volatility. As much as the markets play a role in your strategy, I have to assume issuance does as well.
Yeah, I mean, if there's any negative to our strategy over the last few years, it's that issuance has somewhat declined, but that's kind of understandable, right? The interest rates are very low, and until recently, credit spreads are very tight. And the VIX until August was trading below 20, so that's generally not a great environment for issuers to decide to issue converts. That said, as we see by this environment, at least we still have the low interest rates, but credit spreads are much wider and volatility is much higher, so who knows what we'll see down the road.
What do you make of this strategy versus others? I mean, you're competing, right, with a ton of other hedge funds out there to try to get, I don't want to say the same money, but you're all pitching your strategy. Why is your strategy better than anyone else's out there, or where do you see the advantages from where you sit?
Well, two things. First, convertibles are fungible, which means I can convert it at any time. So the issue of leverage. You don't have a
liquidity problem.
Well, liquidity could be an issue, but if liquidity was to go away or exit the market, I can always have the option to convert. And that tends to be investors' problems or concern with issuing or investing in leveraged strategies. They don't want to have too much leverage. Converts, while it is inherently a leveraged strategy, takes somewhat of that risk away.
And just to remind people, I mean, essentially you're buying, you have this choice. In other words, it's a hybrid security, just to remind people or to tell people who may not know.
Yeah, sure. A convertible bond is essentially, it's a bond, and it has a maturity date. At maturity date, the issuer is required to pay you back your principal. That said, if the underlying stock price goes through a certain strike price, then you have the right to convert and take the stock instead.
So you have some choices, as you pointed out. David, I know we're going to take a quick break. David Rich is still beside me here, the founder and CIO of Amida Partners. David, we were talking in general about your strategy. You do a lot with convertible bonds. You see some specific picks out there that you like for your own fund. Can you share one or two?
Sure. Well, as we said a few minutes ago, in order to make a convertible make sense, there's two components. There's a bond component and an equity component. So in order for it to be cheap, that means both of those components need to be reliable. So a great plain vanilla example is Salesforce.com. The reason we like Salesforce.com so much is because both of those components are reasonably explainable. The bond component is great because it's a software company with $15 billion of market cap, which is fairly enormous relative to their debt load, which is only about $500 million, and they have far more cash and marketable securities than they do debt. So that tells me that their ability to repay me at maturity is pretty darn reliable.
Right, it's pretty good, right? I mean, and they generate something like $400 million in earnings, right? Every year.
Pretty amazing. At the same time, their stock price trades at about 85 times trailing 12-month earnings, which tells me that over the next 3 to 4 years, I have a very reasonable chance of the stock going way, way up. I have a very reasonable chance of the stock going way, way down. Either way, that's good for me and my convertible.
David, I'm glad you're explaining a little bit too, because even, as you said, converts are hard to understand because there's a lot of moving parts. You have the bond components, you also have the equity component. So it's good for people to hear actually how you are evaluating each part of the equation. I mean, obviously in simplistic terms, but at least for our purposes. Salesforce.com, not the only one you like. What else is out there that you're watching?
Well, Salesforce.com is a nice plain vanilla example. I construct the trade, I can buy and sell the stock when it goes up or down, and we're open to tail risk, if you will. If the stock moves up a lot or moves down a lot, that should work very nicely in our favor. Another nice example is a completely different trade for a company called Alliance Data Systems, and they're essentially a marketing company. They do private label credit cards, among other things, but their convertible we call the construction synthetic put type of construction, which means the stock price right now is 100% in the money, or 2 times the strike price. So the optionality of it is less than a Salesforce.com, which is trading much closer to the strike price. But go ahead.
And what does that mean for your strategy, David?
Sure. I mean, a nice way to understand the Alliance data system is to look at it from an outright perspective, an outright meaning long only. And right now, the bonds trade at about 211 cents in the dollar, or 2.11 times par. But the stock value is 200 cents in the dollar, which means, actually, I said that wrong. I think it's 9-point differential between the bond price and the stock value, which means I'm only paying 9 points above the stock, but over the next 2.5 years, I expect to get back more than 12.5 points. So just on that note, a rational investor would never buy the stock over the convertible
Right, because
bond.
the stock right now also, we should note, is trading pretty near a 52-week high.
Yes.
So also, most people, I guess, could feel like they're a little bit too late to the party if they just bought the stock.
Well, that's where the synthetic put component comes in. So we don't just buy the convertible. We also sell the stock short to hedge, if you will, our stock exposure. But if the company does have some leverage, if the stock were to move down precipitously, we should also stand to gain and benefit by that embedded put option in the convertible.
All right, David, thanks for coming by, talking to us about some of your positions, strategies, why you like them. David Rich joining us there from Amida. Welcome.